Okay, Bismillahirrahmanirrahim. Assalamualaikum. Now I'm going to continue to explain to you about flexible budget reports. What is a flexible budget? So flexible budget projects budget data for various levels of activity. Hopefully you still remember when we talk about the static budget. So static budget looks only at a single level of activity or one level of activity. But if we are looking at the flexible budget, we are actually looking at various levels of activity. So basically, flexible budget essentially is a series of static budgets but at different activity levels. So budgetary process more useful if it is adaptable to changes in operating conditions. What does it mean? So basically, if you simply look at a single level of activity, it is less useful in terms of the comparison, for example. But if you look at these, you take into consideration the changes in the operating condition, then the budgetary process will be more useful and more adaptable. And then it can be prepared for each type of budget in the master budget. So hopefully you still remember our master budget. So at each level in the master budget, we can prepare the flexible budget, starting from the sales budget up to the production budget and so on, right? Okay, so let's look at the illustration on why we use the flexible budget. So you have this one, Barton Robotics static overhead budget. So here we are looking at the overhead budget. Okay, you are looking at the overhead budget and you are being given this information. So the budgeted production in units is 10,000 units and you are being given the cost. So these are all the budgeted costs. That is under the overhead budget. Okay, under the overhead you have the indirect materials, you have the indirect labor, utilities, depreciation, the taxes and the supervision. So you are being given this information, and then this one is the budgeted production in units for 10,000 units, and this is the budgeted cost, the 1.1 million, right? This one is 1.1 million ringgit is your budgeted cost. And then what happened is that if let's say assume now you produce 12,000 units instead of 10,000 units in your budget, your actual production is 12,000 units, and this one is the cost that you have just now. Remember this one, you have the 1.1 million, so this one is your 1.1 million that is based on the budgeted cost, your overhead cost, and this one is the actual cost that you have incurred for that particular period. So you have incurred 1.232 million, right? This one is your cost. So if you are talking about the cost, you budget 1.1 million and then you incur 1,232 million, so which is much higher than what you have budgeted. In that case, you will have an unfavorable variance. So the difference is 132,000 and this one is unfavorable. So where does the different lie? So that means you look into the component of your overhead budget. So here, if you see your indirect materials, you have budgeted your indirect material of 250,000 and you actually incur 295. So you have incurred more than what you have budgeted. Therefore, the difference of 45,000 is unfavorable. The same goes for your indirect labor. That means you have budgeted 260,000 and then you incur 312,000. So you have incur more cost of indirect labor by 52,000. So this one is unfavorable variance. The same goes for your utilities of 35,000. So total of this gives you 132,000 unfavorable variance. And then when you see over budget in 3 of 6 overhead costs, so you can see here, out of your 6 overhead costs, you have 1, 2, 3, 4, 5, 6. Out of this, 3 is 3 means over budget. So this one over budget of 132,000 and that accounts for 12%. So 12%, that means you take 132,000 over your 1.1 million, you will get 12%. So that means you have over budget by 12%. But when you further investigate, that you found out that this one, the data that you are being given is for 10,000 units, and then it is meaningless to compare the actual variable cost for 12,000 units with the budgeted variable cost for 10,000 units. As we know, the variable cost, the nature of variable cost, if you still remember, the cost, you have the fixed cost, you have the variable cost, and the nature of the variable cost is that it varies with the level of activity, or in other words, it increases as your production increases. So it is meaningless for you to compare 12,000 units and at the different level of activity here. You compare the 12,000 and your 10,000. So what should you do? So now there comes in the flexible budget. You remember just now what we did is we are looking at a static budget. Now we flex the budget. We flex the budget in the sense that we need to compare apple and apple, orange and orange. So is it meaningful for you to compare this one? You budget at 10,000 units and your actual is 12,000. So you cannot compare that, right? You cannot compare different level of activity. So what should you do? You need to flex your budget. So now you need to flex your budget, this one, flex it so that it will reflect your 12,000 unit as well. So then if your budgeted figure is at 12,000, you can compare with your actual 12,000 units of production. So in that case, your comparison will be meaningful. Hopefully you understand that. So now what you need to do, how to do the calculation, or how to flex your budget. So what you need to do, you analyze your budget data for cost at 10,000 units. Here you are being given the cost for your indirect material 250,000, the indirect labor 260, and utilities 190. This one, where do I get the figure from? Here from 250, 260 and 190, right? This one are all your variable cost. So then you find the per unit cost. So you find the per unit cost. How do you get it? 250, because you are being given the information just now. This one is for 10,000. So this one is for 10,000. So 250 divided by 10,000. 260,000 divided by 10,000. 190,000 divided by 10,000. So you will get per unit. Okay, you will get the per unit. Here you will get 25 ringgit per unit for your indirect materials, 26 for your indirect labor, and 19 for your utilities. So in total, you will have 70 ringgit per unit. So next step, once you have identified the per unit result, then you can work it out if, let's say, you produce 12,000 units. So if you produce 12,000 units, one unit carries 25 ringgit. So if I produce 12,000 units, that will be 25 ringgit times your 12,000. So that will give you 300,000. So you do the same thing for your indirect labor and for your utilities. So 26 per unit times 12,000. Okay, times 12,000, you will get 312, and you do the same thing for your utilities, you will get 228. So in total, you have 840,000 instead of 700,000. Remember, the 700,000 is for 10,000 units, whereas your 840,000 is for the 12,000 units. So when you prepare the budget report, you prepare that report based on the flexible budget. But now the difference you can see now, here your budgeted figure is 12,000. It is no longer 10,000, but it is 12,000. This one is to reflect the same level of activity as the actual cost that you have incurred for 12,000 units. So you work out just now, this one, you already work it out here. This one 300, 312 and 228, total of 840. So your total variable cost for your indirect material will be 300, your indirect labor 312, and your utilities 228. So that gives you a total budgeted cost of 840. And then you do the comparison with your actual data. So this one you are already being given the actual data for your component, indirect materials, indirect labor, and utilities. This one you are being given the same thing as the static budget that you have done just now, but you flex your budget so that it reflects the 12,000 units level of production or level of activity. Okay, this one. So now you compare 300,000 and 295. So what have you found? You will see that now the difference is 5,000. But the difference of 5,000 is favorable. It is no longer unfavorable, but it is in a positive direction. That is 5,000. Because to produce 12,000 units, you should have spent 300,000 of indirect materials. But in actual fact, you only spent 295,000 ringgit. That means you have had a positive difference of 5,000. So that is favorable variance. And then you compare your indirect labor, there is no difference. And you compare your utilities, and you found that again, you have incur a lesser amount. You should have spent 228 based on the budgeted figure, but in actual fact, you only spent 225. That is a positive or a favorable variance. But if you look at your fixed cost, there is no difference in terms of your fixed cost. Your budgeted figure and your actual figures are the same. So your total fixed cost, there is no difference in between your budgeted and your actual cost. But with regard to your total cost, there is a difference because it's been reflected in your variable cost. So you will have 8,000 ringgit favorable variance. So this is how you prepare the flexible budget, right? So this is how you prepare the flexible budget. And if you see here, when you want to prepare or develop the flexible budget, so what you need, the steps will be, you need to identify the activity index or the relevant range of activity. In this case, you identify it is from the 10,000 to 12,000, and then you identify the variable cost. You identify the variable cost. From there, you determine the variable cost per unit as what we have done just now. You identify the variable cost per unit. Then you identify the fixed cost, and then you determine the cost for each of these items. Next, you prepare the budget based on the level of activity within the relevant range. In this case, you are doing it for the 12,000. So if you see, flexible budget gives you a more insight or richer information, in the sense that it looks into the you are comparing apple and apple. You are comparing light with light, right? You are comparing at the same level of activity. Okay, so hopefully you have a better understanding. So in terms of the comparison, it gives you a meaningful information. So hopefully you have a better understanding on this. So with that, I thank you.